You'd think companies would always chase the absolute lowest borrowing cost no matter where they are in the world, right?
Yeah, that seems logical.
But it turns out it's not always that simple. We're seeing this interesting trend. Even when interest rates on US dollar debt aren't the lowest available, there's still this kind of magnetic pull towards issuing bonds in dollars.
Hmm.
It's happening all over the world. So, in this deep dive, we're going to untangle why the US dollar has this really strong hold on global corporate bond markets.
Sounds good.
You've given us some really interesting research on this.
Uh-huh.
And today, we're on a mission to figure out how CFOs make their way through this dollar-centric world,
Right.
how they get the financing they need and keep their companies moving forward.
Yeah.
So we'll look at the dollar's influence, kind of like the foundation of everything.
All right.
And then we'll dig into how companies actually come up with strategies for debt financing.
Makes sense.
It's fascinating to think about how this whole dollar dominance even came about.
Yeah, it's not an accident.
Like, the Wikipedia entry on the US dollar pointed out that Bretton Woods Agreement after World War II was a huge turning point.
Yeah, I think a lot of people forget about that.
It basically put the dollar right at the center of the global money system.
Right.
And in doing that, it kind of pushed aside the pound sterling.
It really did.
But even before that, like even after World War I, the dollar was already becoming a major player for global reserves and transactions.
Yeah, definitely gaining traction.
I think that historical perspective is really important here
Absolutely.
because it shows us that the dollar's power today, it's not just by chance.
It's not some overnight thing, right?
It's built on like decades of economic and geopolitical stuff happening.
Yeah. Decades of developments.
Right. And that legacy from the past is still shaping what's happening right now.
For sure.
Today, the dollar is not just the main currency for international trade.
It goes way beyond that.
It's the official currency for a bunch of countries, and it acts like the de facto currency and even more.
Yeah, it's pretty widespread.
Think about these big multinational corporations with operations all over the place.
Yeah.
A big chunk of their business, whether they're based in the US or not, often involves dollars.
Right.
So when these companies want to raise a lot of capital by issuing bonds, tapping into that dollar market.
It often becomes the obvious choice.
Yeah, and sometimes it's like the only choice.
Right.
But what makes it such a strong option for CFOs?
Well, if you zoom out and look at the bigger picture, issuing debt in U.S. dollars gives companies access to this absolutely massive and super liquid pool of investors.
Massive.
Huge. The U.S. capital markets are just unparalleled globally in terms of depth and breadth.
I see.
And it's not just about the amount of money available. It's also the sheer variety of investors you have.
Variety, okay.
You've got these massive pension funds. You've got insurance companies, specialized mutual funds, ETFs, all actively participating.
Wow, that's a lot.
And this deep liquidity means companies can often issue really large amounts of debt without causing huge price swings.
So it's stable.
Relatively, yeah. It's a capability that very few other currency markets can offer consistently.
Interesting.
Then you also have to consider that many companies, especially multinationals, generate a significant portion of their revenue in U.S. dollars.
Mm-hmm.
So by issuing debt in the same currency, they're creating a natural hedge.
A hedge. Yeah.
This helps reduce their exposure to the ups and downs of exchange rates between their earnings and what they owe.
So you're saying they align their financial obligations with their income streams.
Exactly, to minimize those currency risks.
That makes total sense.
Yeah.
Now, for a CFO thinking about a bond issuance in US dollars, picking the currency is just the first step.
Right, there's more to it.
They then have to deal with all these crucial factors that will seriously impact their company's financial health.
And future growth.
Yeah, and one that's always on their minds is interest rate risk.
For sure.
So how do CFOs handle these inevitable interest rate changes?
Well, the Wikipedia article on the U.S. dollar makes a good point about monetary policy being a key driver of interest rates.
Right.
And in the U.S., the Federal Reserve has a lot of control over those rates through its various policy tools.
Mm-hmm.
So any company with debt in U.S. dollars is basically exposed to the Fed's decisions.
Exposed. Okay.
If the Fed decides to raise interest rates, let's say to fight inflation, the cost of servicing that dollar-denominated debt can go up.
And that could hurt.
It could squeeze a company's cash flow, yeah.
Yeah.
So CFOs use all sorts of sophisticated financial instruments and strategies to try and minimize this risk.
Oh, I bet.
One common tool is an interest rate swap.
An interest rate swap. That sounds kind of complicated.
It's not as complex as it sounds. At a high level, an interest rate swap is basically an agreement between two parties.
Okay.
They agree to exchange one set of interest rate payments for another based on a specific principal amount.
So like trading payments.
In a way, yeah. For a company that's issued dollar-denominated debt with a variable interest rate, they might use a swap to exchange those variable payments for a fixed interest rate.
Fixed. Oh.
This lets them lock in their borrowing costs, which helps with predictability. They know what their cash flow will be.
I see, less uncertainty.
Exactly. And it shields them from potential interest rate hikes, especially if the Fed is hinting at future increases.
So it's a way to get more certainty.
Yeah, in an uncertain environment.
That makes a lot of sense. Now, another big factor that affects a company's borrowing costs is its credit rating.
Right, creditworthiness.
We all sort of know what a credit score means for us as individuals.
Yeah.
But how does that translate to these giant corporations?
Well, for companies, credit ratings come from independent agencies like Moody's, S&P, and Fitch.
Okay.
They basically assess a company's creditworthiness.
So their ability to repay their debts.
Exactly. Their ability and willingness to meet their financial obligations, especially paying back their debts on time.
On time, that's key.
A higher credit rating means a lower risk of default.
Lower risk, got it.
And what's really interesting is the direct connection between these ratings and the interest rates a company has to offer to get investors to buy their bonds.
So the rating affects the interest rate.
Absolutely. Investors don't like risk. They want a higher return if they're taking on more risk.
That makes sense.
So a company with a lower credit rating will usually need to offer a higher interest yield on its bonds.
Higher yield for higher risk.
Compared to a company with a really good credit rating.
Oh, okay.
It's all about risk and reward for investors.
Right. And you mentioned how important it is for CFOs to optimize their company's cash flow.
Yeah, it's crucial.
So how does keeping a good credit rating help with that?
Well, if we link it back to the bigger picture, a strong credit rating gives a corporation this powerful advantage. They can access capital at a lower cost.
So less risky means cheaper borrowing.
Yeah, lower perceived risk means lower interest expenses on their debt.
Got it.
Those reduced interest payments then free up more of the company's cash flow.
More cash freed up? Okay.
And that freed up cash can then be used strategically. Reinvested back into the business for growth, research, or even giving back to shareholders through dividends or share buybacks.
Dividends, all right.
On the flip side, if a company's credit rating gets downgraded,
Not good.
that can lead to much higher borrowing costs down the line.
Makes sense.
It restricts their financial flexibility, and that could potentially impact their growth.
So good credit rating is really, really important.
Absolutely. It opens doors.
Now, when we talk about credit quality, the term subprime often comes up.
Yeah, especially with what happened in the housing market.
Right, the housing crisis. We even have a definition of a subprime mortgage in the resources you provided. Basically, loans given to borrowers with not so great credit history.
And higher interest rates because they're considered riskier.
Exactly, to compensate for that increased risk of default.
Right.
So is there a direct equivalent of subprime in the world of corporate bonds?
That's a good question. While we don't usually use the exact term subprime to categorize corporate debt,
I see.
the idea that higher risk means higher borrowing costs definitely applies.
Okay.
In the corporate bond market, you have what are called high-yield bonds.
High yield. Okay.
Sometimes they're called junk bonds, a bit more informally.
Junk bonds, I've heard of those.
These are bonds issued by companies with lower credit ratings.
Riskier companies.
Yeah, they carry a higher risk of default compared to investment-grade bonds.
Investment grade being the safer ones.
Right. And to make up for this higher risk, these high-yield bonds offer investors a higher potential return.
Higher return, higher risk. Got it.
It's important to remember that while the concept of risk-based pricing is similar to the subprime mortgage market,
Yeah.
we're talking about debt issued by corporations, which has different dynamics and regulations than consumer mortgages.
Right. That's a key difference. Now, even with careful financial planning and a good credit rating, sometimes unexpected things happen. What happens when a corporation is having trouble managing its current debt?
Things get tricky.
That's where debt restructuring comes in, right?
Exactly. Debt restructuring strategies are basically a toolbox for corporations.
The toolbox.
They use these tools when facing financial difficulties or when big market shifts make their existing debt load unsustainable.
I see.
These strategies involve a bunch of actions, like renegotiating the terms of existing debt agreements with lenders.
Renegotiating. Okay.
This could mean extending the repayment period to ease the immediate cash flow pressure.
Makes sense.
lowering the interest rate to make the debt more manageable,
Easier payments.
or even doing a debt for equity swap,
Mm.
where creditors exchange their debt for ownership in the company.
Ownership, wow.
The main goal of debt restructuring is to optimize the company's cash flow,
Okay,
relieve that financial stress,
right.
and in more serious cases, to avoid a complete default.
Default, that's the worst case scenario.
It allows the company to find a more viable way forward.
A path forward, yeah.
Exactly.
So far, we've been really focused on the dollar's role at the center of all this.
Yeah.
But in the global financial world, there are other big players too,
It's sure.
like the euro.
A major one.
So how does having another major global currency like the euro affect decisions about issuing corporate debt in US dollars?
This brings up a really important point about how interconnected global finance is.
Okay.
The ECB Economic Bulletin, which you included in your research, gives some great insights into how the euro's exchange rate works,
The exchange rate.
how strong or weak the US dollar is compared to the euro.
Uh-huh.
Like we might see in that bulletin or in real-time Forex live updates, can definitely impact the calculations for non-US companies thinking about issuing debt in dollars.
Calculations. Okay.
For example, if the dollar is really strong compared to the euro, a European company with dollar-denominated debt might see their repayment costs go up when they convert it back to euros.
Because of the exchange rate.
Exactly. Conversely, a weaker dollar might make dollar-denominated debt more appealing for European issuers.
I see.
It's a constant evaluation, a balancing act,
Balancing act. Okay.
influenced by those exchange rates and predictions about how they'll move in the future.
So it's like a global assessment of currency values affecting these borrowing strategies.
Yeah, a continuous assessment.
We've been looking at this through a pretty traditional financial lens.
Right, the numbers.
But the introduction to behavioral economics reminds us that people don't always make perfectly rational decisions,
Uh-huh.
driven just by the best financial outcome.
It's not always that straightforward.
So could behavioral factors also influence how CFOs decide about issuing debt in dollars?
It's definitely worth considering. Decisions about something as fundamental as corporate debt might not always line up perfectly with those perfectly rational choices predicted by economic models.
Models can be limited.
They can be. Prospect theory, a key concept in behavioral economics, shows how the way choices are presented and the broader context can really impact risk-taking and decision-making.
Interesting.
For instance, a CFO with a history of success issuing debt in US dollars might be more likely to stick with what they know,
Even if there might be a better option.
even if market conditions suggest that issuing in another currency could be slightly better financially.
So they stick with the familiar,
Yeah, it's called the familiarity bias. It can lead to decisions that aren't optimal.
where the comfort of the familiar outweighs the potential benefits of something new.
Precisely. And this kind of inertia, this preference for the status quo, can actually have real costs for the company over time.
Wow, that's a fascinating perspective. The idea that habits and preferences can influence even the biggest financial decisions.
Absolutely.
Now, one of the sources you provided, the BIS paper on historical monetary and financial statistics, talks about the territorialization of money and how monetary unions have developed over time. How does looking at this historical context help us understand the dollar's current power in these corporate debt markets?
If we step back and consider the long view of history, like that BIS paper encourages, we see that the US dollar's dominance isn't a sudden thing.
It's been a process.
It's the outcome of a long and complex evolution.
Makes sense.
The territorialization of money, basically establishing a single currency within a specific geographic area, was a crucial step in building modern economies.
The foundation, yeah.
The dollar's rise to global importance in trade and finance is a more recent part of this ongoing story.
A new chapter.
This historical perspective tells us that while the dollar's on top right now in corporate debt markets, those currency hierarchies can change.
So things could shift.
They could, but those shifts tend to be gradual,
Gradual.
driven
Yeah.
by big underlying changes in global economics and political power.
So big changes would need to happen.
Right. And the fact that monetary unions have developed so slowly and with challenges throughout history shows us just how deep-rooted those factors are that lead to a dominant currency being stable and widely accepted.
Deep-rooted factors, I see. So bringing it all together, our deep dive has shown how the US dollar's strong position in the global financial system makes it a cornerstone of corporate debt markets.
For sure.
CFOs have to juggle all sorts of complex considerations.
Lots to balance.
They've got to balance the advantages of tapping into that huge liquid investor base.
And aligning debt with dollar-denominated revenues.
Right, but also managing interest rate risk really carefully.
Yep.
And keeping those credit ratings strong.
Absolutely crucial.
And we learned that even with those traditional financial models, behavioral economics shows us that psychology and established norms can also have a big impact.
They can definitely influence those decisions.
And finally, taking that long-term historical view reminds us that the current situation is a product of a long evolution.
A long history.
It doesn't have to stay this way forever.
Things can change.
This all leads to a pretty big question for you to think about. Given how reserve currencies have shifted in the past and how the global economy and geopolitics keep changing, how long can the US dollar stay this influential in global corporate borrowing?
It's a good question.
And with all the talk about digital currencies and geopolitical shifts happening, what new strategies might CFOs need to think about?
Right. Beyond just relying on dollar-denominated debt markets.
How can they make sure their companies keep accessing capital and growing sustainably?
It's a complex area with lots of angles.
Yeah, a lot to consider.
Plenty for you to explore based on your own research and what you learn.
It's a fascinating topic.
It is.
And it'll be interesting to see how it all evolves.
Yeah, definitely. Thanks for having me.
Thanks for joining us.
It's been great.
It's been a pleasure.
Take care. You too.